But as the earnings season kicks off today, with TCS set to post Q1 results, let's first understand what the entire setup is expected to look like for Nifty 50 companies and the sectors. Mahima is going to give us a quick overview, and then we will have Amnish Aggarwal from Prabhudas Lilladher joining in. Mahima, over to you.
Right, so I'll start with the auto sector. Q1 sales growth has been tepid and meaningful growth showed only by TVS, M&M as well as Eicher Motors. So near-term outlook is weak here. Banks net income to decline on weak revenue growth. Loan growth for frontline banks could be anywhere between 7 to 12%. Public banks to have higher impact in Q1 and private banks to see higher impact in Q2. IT, well, tariff-led disruptions can impact spending in the US. Expected muted revenues in tier 1 names, and 4 to 5 large IT companies expected to see sequential declines as well. In the consumption space, well, staple companies to see sluggish urban demand to continue and high cost on inventory as well. Marginal pickup in volumes is expected. Operating margins to remain subdued. Paint companies to see high muted demand on the back of competition. Alcohol companies muted volume growth on account of a higher base. Jewelry companies to see good revenue growth on the back of rising gold prices, and QSR companies could see muted demand in Q1 FY26. In terms of power, the momentum has seen nationwide overall capacity additions that have remained healthy, but current power demand remains soft. Demand is expected to rebound in the coming months. In real estate, pre-sales expected to improve sequentially and annually. Overall, DLF and Prestige is expected to lead the growth in pre-sales booking as well. Approval in delay is a concerning factor here, so we'll have to wait and watch out for the new launches as well. Pharma sector, the performance will be impacted by weak domestic and US generics competition, and PAT growth to be led by lower tax as well. Lastly, in terms of metals, the spread to expand on sharp hike steel prices, and expect domestic volumes to be good. So this is the overall view of what you can expect from different sectors and Nifty 50 companies.
Okay. Thanks a lot for that, Mahima. Standard disclaimer, by the way. These are not. This is all NDTV Profit research, a combination of some of the stuff that we've read from various reports. For the Prabhudas Lilladher view, we now get in Amnish Aggarwal, Director Institutional Research at PL Capital. Amnish, thanks so much for taking the time out. Am I saying it right when I'm saying it's the Prabhudas Lilladher view when we get to you? Or is it now officially PL Capital?
Is the name changed 1 year back? It's better if you run PL Capital.
Yeah, no, we've written PL Capital only. It's just out of habit because the legacy of Prabhudas Lilladher stays on per se. But great. So, okay, let's get the PL Capital view from Amnish. Amnish, how do you see the earnings this quarter? Tepid or the low base helps show growth?
You see, the overall outlook remains mixed. There are, you can say, segments where the growth rates are still tepid. The consumption space, if you look overall, barring a few companies in auto, that remains pretty, I would say, pretty tepid. You look at the building material space, you look at consumer staples. So in the consumption space, it is a jewelry which is showing good value-led growth. But otherwise, I think all the companies, they are more like your low single-digit to mid-single-digit kind of a territory at best. Some benefit of, you can say, benign raw material prices are there. So across consumption space, I don't think that there is going to be any big fireworks, and it is only going to be a very, very company-specific approach over there. Now, moving away from consumption, I think the capex-oriented sectors, particularly if you look at the capital goods, I think that looks quite encouraging. You can say 15-16% kind of, you can say, beta growth you can expect. This growth number had actually gone down to single digits couple of quarters back, but after that, I think now it's improving. The order books are also seemingly quite good over there. So that is one sector which is doing well. Then on the healthcare side, particularly hospitals, they continue to show momentum. Something like 15 to 18% kind of an average EBITDA growth is visible in case of hospitals. Then your commodity-led sectors, if you look at, say, cement, because of a lower base, your EBITDA per ton has moved up, although volume recovery is not that much. But because of margins, profitability is going to be better. Cement, your metals are more like stay put, reasonable quarter for them. And the overall numbers are going to get skewed again by, you can say, oil and gas, where the growth rate seems to be quite decent. So among other sectors, I think banking will remain muted, NBFCs will be better, and you will see IT, as you also said, IT services is not likely to post any great numbers during the quarter. So I think it is pretty much, I would say, mixed. Consumption still remains under pressure. Your capex still remains better, led by the government initiatives, and I think that's pretty much the story.
Amnish, what sector do you reckon are you contrarian on relative to what the street may be either bullish or bearish on when it comes to just the earnings delivery, not the buy or the sell number, or not the stance, just the earnings delivery?
You see, earnings delivery will depend a lot on how the consumption demand pans out. Because if you look at the capex side, I think the government capex is holding on fine. If you look at the particularly the consumption side of it, I think that is where the problem has been there from the last 12 to 15 months. So it is showing, I would say, sequential improvement. There are some signs of improvement, but another factor is that the listed companies today in the consumption space in several pockets, they might not be the true representative of the state of affairs over there, because there's a large unlisted space over there. There are a large number of startups which are there, which are also eating into the market. So yeah.
Anish, with everything said and done, in terms of the individual sectors, the views that you've given, if you have to look at FY26 as a whole, and this is just the start, how would you expect Nifty 50 earnings to pan out from a top line and bottom line? What are you baking in terms of your estimates? And to add to that, how would it actually reflect in terms of your Nifty base case and bull case target for the next 9 to 12 months?
You see, I can't give you the target numbers as of now because we are yet to release our strategy report in terms of what our Nifty target is and what our aggregate numbers are. But definitely, I think last year we had just around 4% Nifty EPS growth if you don't include the exclusions or additions into the indices. So we believe this year is definitely going to be better than what it was last year, because the government capex has revived. Your peak of inflation is now over in case of commodity sectors, and even consumption is showing, I would say, better momentum than what it was, say, a couple of quarters back.
Okay.